In the perennial battle between experts and randomness, the tale of the dart-throwing monkeys truly stands out. Monkeys, oblivious to the intricacies of financial markets, picked stocks by throwing darts at board listings, and, astoundingly, their selections often outperformed those made by seasoned financial experts. This experiment, while whimsical, taps into a stark truth: the limits of human expertise in predicting stock market trends. The craft of predicting stock market movements has often been likened to reading tea leaves, an art shrouded in mystique and beset with uncertainty. Expert forecasters depend heavily on models constructed from historical data, but as celebrated economist John Maynard Keynes famously noted, "The market can stay irrational longer than you can stay solvent." This suggests a humbling premise. Despite the accumulation of copious data and advanced algorithms, the precision of market prediction remains elusive. The vulnerabilities in expert financial forecasting arise from several quarters. Firstly, the intrinsic nature of the stock market is complex and influenced by a myriad array of unpredictable variables. These range from geopolitical tensions and economic policies to technological disruptions and behavioral economics. No single model, irrespective of its sophistication, can adequately encapsulate this vast web of interdependencies. Moreover, the financial markets are reflexive, reacting not just to external circumstances, but also to the predictions themselves, thereby creating a feedback loop that further confounds the predictive process. The psychological dimension plays a crucial role too. Experts, susceptible to their biases and egos, often fall prey to the illusion of control, a cognitive bias that conveys a misleading sense of command over essentially uncontrollable events. This psychological predisposition can skew risk assessment and decision-making processes, leading to predictions that are more optimistic or certain than warranted. The confirmation bias, the tendency to favor information confirming one's preconceptions or hypotheses, only exacerbates this issue, as analysts and experts might dismiss critical data that contradicts their forecasts. In the late 20th century, the Wall Street Journal carried out a series of experiments that became a seminal case study in the conversation about expert accuracy in financial forecasting. In these experiments, staff journalists played the role of the monkeys, throwing darts at boards of stock listings to select portfolios. Their random selections were then compared with the choices made by professional money managers. Surprisingly, or perhaps not so surprisingly, the dart selections often performed comparably to or even outstripped the expert picks over the investment period. This empirical evidence not only challenges the notion of superior expert performance, but underscores a larger, more systemic issue: the market's inherent unpredictability. It brings to light that in a domain riddled with vast uncertainties, even the most informed and sophisticated predictions can falter against sheer randomness. This revelation lends credence to financial theories, suggesting that stock price movements are fundamentally unpredictable and may follow what mathematician Benoit Mandelbrot referred to as a wild randomness. This discourse not only recalibrates our appreciation of expert capabilities and the limits of predictive analytics, but also democratizes our understanding of financial investments. As we tussle with the numerous factors influencing financial markets, the monkey dart experiments serve as a humbling and instructive fable. They caution us about the folly of overconfidence and remind us of the capricious nature of markets, a lesson that remains particularly salient in today's volatile economic climate.